If you watch investing content, you might think to yourself, man, if this stuff is really so easy, how come everybody isn't just investing and getting rich? You may have seen all the videos about markets declining, bubbles bursting, and people losing money and thought, are stocks worth it? This video will answer if investing in stocks is worth it, how they make you money, and what pretty much anyone can do to guarantee that they'll become rich. Hi, I'm Evan, and let's start with the basics. What is stock? Stock represents a piece of ownership in a company. So if you own shares of Tesla, you own a small portion of that company. Companies issue stock to raise money, which they could also do by issuing bonds or spending cash on hand. These would be debt financing and using retained earnings, respectively. Stocks are special compared to other financing options because they erase some control within the company. People who own shares and thus portions of companies are entitled to have a say in how the business is run. This is why you hear in the news that some business did this to appease shareholders. Those who own stock get to vote on certain things, such as electing members to the company's board of directors. So you may be thinking, why do companies even issue stock if they have to give up control? Why not just pick their own board of directors? Or why don't they just decide how the business is run themselves? This is because if they didn't, it would be extremely hard to raise money. Sure, you could get a business loan, but then you'd be limited as to how much money people are willing to give you. You could spend your own cash on hand or retained earnings, but then you're limited to how much money you have on hand. Companies issue stock to raise money now by promising returns through future performance. I'm going to say that again because it's extremely important. Companies sell stock to raise money in the present so that they can use it to improve the business in order to make even more money in the future, which will be used to repay shareholders. So when you choose to invest in a company by buying its stock, it's because you think they will continue to do well and then further improve their performance in the future. Betting on future performance has a huge upside. Just think about how much money you'd have if you were able to invest in companies like Tesla or Google from the start. Now, for the purposes of this video, we won't be talking specifically about startups, but the thought does still make a good point. Stocks have the potential to seriously grow your money. In fact, the S&P 500, which is an index that measures the performance of the top 500 companies in the US, grows by an average of 8 to 10% per year. Compare this to the average savings account in the US, which only gives you a 0.06% return. That's a difference of basically 8 to 10% a year. So then why doesn't everyone just make a bunch of money in the stock market with those kinds of returns? This is because investing in stocks can also be risky. If you invest in a single company, it has the potential to go bankrupt, leaving your shares valueless. The overall stock market is also generally sensitive to economic conditions and other things going on in the world, creating volatility. This is the constant back and forth, up and down pattern you see in stock returns. So if stocks are risky, is investing in them even worth it? The answer is yes, so long as you're making smart decisions. Let's talk about the pros and cons of investing in stocks, how to mitigate the downsides, and how practically anyone can become rich by investing in them. The biggest con to investing in stocks is the risk. There are a few ways that you can mitigate it. First, avoid investing in single companies at the start, and that way you won't have the potential to lose your entire investment. Second, you can invest in diversified assets. Common examples are mutual funds and ETFs. These pool money together from a bunch of different investors in order to buy different assets. The performance of the mutual fund or ETF is determined by the performance of its investments. For example, you could buy into an ETF which tracks the performance of the S&P 500. This gives your portfolio exposure to a bunch of different companies and thus a lot of diversification with just one investment. Because your index fund is tracking the S&P 500, you should expect to see that 8 to 10% yearly return, and with less risk than investing in a single company. Third, you should only invest money that you can afford to lose. While the market tends to increase over time, it does have its downturns and crashes like we might be seeing right now. Rates of return are never guaranteed. We say 8 to 10% a year because that's been the historical average. Though of course you shouldn't be expecting to make that number year in and year out. So investing in stocks for the short-term gain isn't a great idea because we predict returns based on the average over the long run. This long-run mentality takes us to the fifth risk mitigation strategy, and that's thinking long-term. After each crash in history, the stock market has eventually recovered and then reached new highs. Even if you invest today and then the market tanks tomorrow, that's okay. You should be thinking about what your investment will be worth 40 to 50 years from now rather than what it will be worth tomorrow. Short-term losses should be expected as much as they suck to see. What's important is that your cost basis for buying shares now is likely going to be super low compared to what they're going to be worth in the future. 6. Dollar cost averaging. This is a strategy to decrease your average cost basis, and that's to just consistently buy into the market. This way you'll buy shares when they're high and also when they're low. This lowers your risk by not making you have to time the market, which is notoriously next to impossible to do. The risk of stocks also plays into one of their benefits. They are correlated with the economy, meaning they increase or decrease based on general economic conditions. Usually the economy is expanding. This means that businesses are making more money which they can use to reinvest into themselves to make even more money. This is why the stock market generally trends upward. It takes pretty major changes in the economy like the 2008 housing market collapse or global lockdowns in order to seriously rattle the stock market. And even after these types of events, the market recovers with enough time. Another risk of investing in stocks that some might consider a con is that shareholders are paid last in the case of a bankruptcy. There's a certain order in which it has to pay back the people that it owes money to. Common shareholders are last after bondholders and preferred stock stockholders. These are different types of shares that don't have voting rights but normally pay higher dividends. As we talked about, you can remove this risk entirely by not investing in single companies. But if you really want to bet on the performance of a single firm, you can buy into an index fund which also invests into that company. You could also consider buying their corporate bonds or preferred stock if available on public markets. All of these options will give your portfolio exposure to the company with less risk. One major benefit of stock investing that we need to talk about is your money's purchasing power. I've talked about this a lot lately, and you're likely familiar with inflation. This is the decreasing the amount of stuff that your money can buy over time, called its purchasing power. Inflation tends to grow by about 2 to 3% a year, although it has been pretty out of control lately. This growth in inflation means that every year, the money you already have is decreasing in value by 2 to 3%. So if you invest, your money should be able to grow at a faster rate than inflation, thus maintaining and actually increasing your overall purchasing power and your wealth. Going back to the 8 to 10% yearly growth, your real rate of return would be 5 to 8% a year. Real is just a term for adjusting money's value to account for inflation. One of the biggest cons I hear about stock investing is that it's pretty complicated. The hardest class I took in college was about researching investments, so I can understand why this is true. However, you can make investing so much simpler by following the advice in this video and some of my other content. Rather than trying to beat the market, you can just buy the market through S&P 500 index funds. If you still want to get into picking individual stocks, go ahead. Just understand that you'll need to do a lot of research and that you should diversify your investments. There's a lot of information available online for free, and so long as you can do a couple things in Excel, you'll be able to do most of what I learned in college. In contrast to this con, let's talk about another benefit of investing in stocks. It's easier than ever nowadays, not only because of all the free resources out there, but there are also a lot of different apps like Robinhood. While I've talked about how investing apps aren't always the best idea, even traditional brokerage firms have apps nowadays. This makes it incredibly easy to invest even on the go. Another benefit tied into the ease of investing nowadays is that you don't even need a lot of money to get started. Many firms offer what are called fractional shares. Like a stock is a piece of ownership in a company, you can then buy fractions of those pieces. The cost of shares of certain companies like Google are really high, so then it would take a lot of money to buy even just one. Instead, you can buy a fraction of a share with whatever money you've got. I use Fidelity, and you can invest in fractional shares for as low as $1. This means that it's super easy to buy stocks, and you don't need a lot of money to get started with buying any one investment. But what happens when your stocks are doing well and you want to sell and make a profit? You might encounter another con: taxes on your profits. This is called a capital gains tax. It's a tax on the difference in price from when you bought an investment to when you sold it. There's a really easy way to mitigate this con, as I talk about all of the time: tax advantaged accounts. You can invest up to $30,150 between the 401k, IRA, and the HSA. These will lower your tax bill by allowing your investments to grow completely capital gains free. For the 401k, traditional version of the IRA, and HSA when not using the money for qualified medical expenses, you will have to pay income taxes on your withdrawn money. However, you won't also have to pay the capital gains tax, so you come out ahead. These tax advantaged accounts are good to help with another benefit of investing in stocks: the ability to generate passive income. Some stocks and bonds will send you periodic cash payments in the forms of dividends or coupon payments. These would normally be taxed like normal income, but not if you have these investments in your tax advantaged accounts. Now, it's pretty hard to make a lot of money through passive income, but you can always reinvest that back into your investments so that they grow faster. But do you know what else some people think is hard? Another con of stock investing: having to compete against the experts. Let me let you in on a little secret. Even the pros have a very hard time consistently beating the market. In fact, historically, less than 50% of the people who actively manage funds are able to outperform their benchmark, and their benchmark is normally the S&P 500. So if the pros have such a hard time, how can you do better? Well, you can do better than at least half of them by just buying into the market and holding. The last con I'd like to talk about is the emotional side of investing. It can be pretty tough to see your balances and your net worth decreasing. I know my stocks are pretty down, but I've taken my own advice and I've built up a long-term mindset. I know that I'm buying in at super low prices compared to what these shares will be worth in 50 years. I don't actively trade either. I just set up a weekly automatic investment. I also rarely check on short-term performance to prevent any potential emotional distress. To recap these different pros and cons and to answer, are stocks worth it? Here is the really simple way that anyone can get rich with enough time. Invest early so that your money has as much time as possible to grow. Invest often so that you can dollar cost average into the market. Hold long term so that you don't miss any of the best trading days. And finally, stick to things like S&P 500 indexes when you're young and you're able to take the risk. That way, you'll boost your average yearly rate of return. With enough time, simply buying into the market and holding long term will beat most active fund managers, and it'll also make you rich. With that, make sure to hold your mouse and beat that like button to make this video rich in the YouTube algorithm. If you enjoyed it or learned something valuable, let me know how I can improve these videos and comment down below. Subscribe and click the bell if you'd like to be notified when new videos come out every Friday. Click that video on screen to watch another that you're going to enjoy, and then please add some music, some stocks that are definitely worth it, or whatever else it is that you love to your day.